Gold is approaching a massive liquidity zone right now, and smart money is absolutely preparing for the next big move. Every single second you spend staring at traditional support and resistance is a second you're completely missing the real institutional order flow. Today's bias is strictly bearish. We're targeting the 4125 liquidity pool, and there's a highly specific sell setup forming, but you have to know exactly what to look for. Let's get right into the blueprint the institutions are actually using today.
So my primary focus today is a potential sell setup right above key liquidity. Like I said, the directional bias, it's heavily bearish. We are aggressively hunting that 4125 sell side liquidity pool. But here's the problem. There is one absolute non-negotiable condition that has to happen before we even think about executing this trade. If you just jump in and enter short right now, you're literally trading directly against the algorithm.
See, most retail traders are looking at the completely wrong level right now. They see the price dropping, right? And they're looking to just buy the dip at random arbitrary support lines. But if we zoom in on the 15-minute time frame, you can clearly see the algorithm has intentionally engineered these beautiful, clean, relative equal lows sitting right at 4125. Guys, that is not a support level. That's a magnetic structural draw. It's specifically designed to trigger retail stop losses and completely liquidate those long positions.
Now, to actually understand the intraday execution, we've got to pan out and look at the macro picture. Look at the daily and 4-hour timeframes here. Notice that severe bearish displacement? Price has just completely violated those key historical structural shelves. Institutional supply is firmly in control here. So our primary premium sell zone sits really cleanly between 4152 and 4162. We absolutely want to align our intraday entries with this massive higher timeframe bearish gravity.
And the why behind that heavy bearish draw? It really comes down to the US dollar index. The DXY is holding at 13-month highs, sitting right around 101.13. This is being driven by a super hawkish Federal Reserve keeping those interest rates elevated. And this strong dollar, it's acting like a massive macroeconomic anchor on gold. You just cannot fight this kind of macro gravity. When the DXY is this aggressive, gold is structurally designed to seek out lower liquidity, period.
But hey, it's not just interest rates playing a role here. There's a lot of geopolitical smoke and mirrors going on too. We've got this recently signed 60-day ceasefire between the US and Iran, but neither side can actually agree on what they signed. The US is claiming total control over the Strait of Hormuz and saying the release of frozen funds has strict humanitarian conditions. Meanwhile, Iran is out here saying the strait is merely a communication channel between equals, and those funds, no strings attached. The market isn't pricing this as a real structural piece. It's a tactical pause. And that underlying uncertainty is keeping institutional algorithms highly sensitive to sudden volatility.
And you better believe that volatility is about to be weaponized. Today's economic calendar is handing them the fuel on a silver platter. We've got high-impact European PMI data dropping right during the London kill zone, and that's followed up by US ADP employment numbers and US PMI data during the New York session. Listen, institutional algorithms do not just react to this news, they use it. They're incredibly likely to use these data releases to engineer a sudden spike in volatility and just sweep liquidity right when retail volume is at its absolute peak. The market is sending a massive warning signal right now on the 1-hour time frame. Take a look. Price is currently buried so deep in discount territory, it's expanded way too far, way too fast without any proper internal mitigation. The algorithms absolutely need to engineer a shallow premium retracement here. Why? To trap late breakout sellers before they finally deliver that true intraday distribution down into those major historical targets we talked about.
Okay, so how do we actually execute on all this? Our institutional trade plan for gold dictates we are looking exclusively for a sell, a short position, but only on a premium retracement. Our high probability entry zone sits perfectly between 4152 and 4162. And why exactly there? Because that is exactly where a prominent 15-minute fair value gap, or FVG, and a breaker block perfectly converge. It's beautiful. Our strategy score on this specific setup is a solid 8 out of 10, and it offers a massive 1 to 3.2 risk-to-reward ratio.
But here's the problem. There is absolutely zero structural evidence of a setup right this second. You cannot just blindly click sell right now. We have to follow a very strict institutional execution sequence here. Step 1, you wait for that premium corrective rally up into that 4152 to 4162 zone. Step 2, you demand a 15-minute market structure shift downward to actually confirm that the algorithm is stepping in. And step 3, enter short upon displacement confirmation. Guys, if you don't wait for this sequence, you're literally just out there trying to catch a falling knife.
All right, so once we're in the trade, how do we manage the risk? This right here is the exact prop firm approved strategy. Your hard stop loss absolutely must go at 41.71. That's the local 15-minute high. If price breaches that level, our thesis is simply wrong and we're out. For targets, we take our first partial profit, scaling out 60% of the position, at 41.34, which is the current session low. Take profit 2 is that major liquidity target we've been eyeing at 41.25, where we'll pull another 30% off the table. And finally, we leave a 10% runner all the way down to 41.10 just to capture that extended 4-hour structural objective.
Now, I want you to really ask yourself something. Where are retail traders getting trapped today? What are the masses seeing when they look at this exact same chart? Because you have to remember, where they get trapped is exactly where smart money makes its margin. This is where most traders get trapped. They're going to do one of two things. They'll either see this deep drop and try to buy the absolute bottom, convincing themselves the price has to bounce, and they are going to get completely run over when that 41.25 pool is violently purged. Or, on the flip side, they see the bearish momentum and they panic sell right now at the absolute lows right before the algorithm initiates that premium sweep into 41.52. Smart money is going to gladly trigger their stop losses on the way up right before taking the market back down.
Now this number changes everything, 41.71. That is the absolute critical invalidation level. If we get a definitive 1-hour candle body close above 41.71, it completely destroys the intraday bearish thesis. Done. It would immediately indicate that a much deeper macro structural retracement is underway to seek out higher liquidity, and we would instantly cancel the short setup. You've got to remember, knowing exactly when you are wrong is just as important as knowing your target.
All right, let's do a final rapid-fire recap of the institutional playbook before these kill zones open up. Our bias? Bearish continuation. The key level? That 41.52 to 41.62 supply zone. The ultimate target? Total liquidation of the 41.25 sell-side liquidity pool. And the action? You wait for the 15-minute confirmation shift. Do not anticipate it. You have to let the algorithm show its hand first.
Patience absolutely pays in this game. If you enjoy this kind of institutional-style market analysis using ICT and smart money concepts, consider subscribing to ICT Market Theory. And hey, if you'd like to actually trade alongside these specific setups, you can find the FXTM account link right down in the pinned comment below. Stay disciplined out there, execute with that institutional edge, and most importantly, wait for your setup.